I hope you're having as much fun at this conference as I am. Until about 7 years ago, I was a partner at a 100-person CPA firm in Pennsylvania. And 10, 15, 20 years ago, I wish I had known about an outfit like this to provide these kind of services to my clients. It would have been a wonderful thing to know about it. And I commend Anton, Ken, Dominique for putting this together. It's an absolutely wonderful conference. I myself have enjoyed it immensely. So I am in the unenviable position of being the last guy standing between you and the bar. And so I will try to make this as pleasant as possible. Also, you might be wondering, what am I doing here? We just heard from Marty. He gave a great presentation about why every company ought to be an ESOP, right? So maybe we ought to just say thanks, Marty, and go home and say to all of our business clients, hey, just become an ESOP. No problem. End of story. Well, maybe that will be your decision after we get through with my program today. I'm a great proponent of ESOPs. I've worked with a number of ESOPs, helped companies establish ESOPs. But I hope at the end of this presentation you will come away thinking, well, maybe there's a thing or three to know other than how to form an ESOP. So with that, let's get started. So I want to start by trying to explain the difference. You don't like my Alfred Hitchcock profile? Okay. Let's get started. So this is our program for the next 50 minutes or so. I want to talk about succession planning versus exit planning. They're complementary, but they're each different in their own way. Give you an overview of the planning process, what's involved in the exit planning process. How does it work in practice? A lot of people have heard about exit planning. I want to present 3 live case examples of clients that I've worked on in the last year to show how this process works in real life. If we have time, I want to address a couple of topics. One of them is financing insider transactions. I don't know if Ami is still here, but he's a wonderful resource on financing all sorts of transactions. And Ami is right down the street from me in Philadelphia, and he and I are soon going to become best friends because I have a lot of clients that can use his expertise in financing transactions. I want to talk a bit about continuity planning, especially for sole owner businesses. And finally, we're going to wrap it up and give a just brief summary of what the key ingredients are for a successful exit plan. Okay, everybody hear me okay? I'd be happy to entertain questions as we go, but I also reserve the right to defer the answers to those questions to either a later portion of the program or to the end of the program if I think I'm going to cover the answer later on or at the end. Okay, what is succession planning? In succession planning, the focus is on the business. You know, key problem. We have a CEO who is getting ready, say, to retire in 5 or 10 years. Well, we have to make sure that we have a smooth transition so that we can replace that CEO at the appropriate time. And that's going to mean recruiting possible replacements, perhaps discussing with key employees in the company whether or not they might be suitable candidates for replacement. Similarly with other key persons in the business, we might have a factory general manager or our marketing VP. We want to make sure as those people are getting to a point in their careers when they're thinking of retiring, we have replacements for them. We have a process.
stand on this side. Stand on
We can
this
start
side.
this? Okay, let's start from the beginning. Okay, so, yeah, that sounds better already. So we want to make sure we have a process in place to replace key people in the business. Management leadership transitions is an ongoing problem and an ongoing process. For those of you who have professional service businesses, you know there's a process when you take young professionals, teach them how to develop client relationships, how to sell new client relationships, how to maintain those client relationships, and when you get to a point in your career when you're looking to retire, somebody has to be ready to take over those relationships. So the focus in succession planning, and this is not only it's personnel intensive, but it also might pertain to financing issues in the business and other things. But the focus is on the business, how to protect the integrity and continuity of the business. That's what I mean by succession planning. What about exit planning? In exit planning, the focus is on the owner. What are the owner's goals and objectives? Does the owner want to work for another 5 years and then retire? What about an owner who wants to sell a business in 2 or 3 years and continue working for another 5 years after the business? The owner is going to have financial objectives. Will they have enough money to retire on after they leave the business? We have to plan for that to make sure they can adequately support themselves. Do they have other financial objectives? Maybe they want to make a significant charitable bequest. Exiting a business, giving up ownership is a great time to consider significant charitable bequests. Maybe the owner has as an objective they want to leave a significant amount of wealth to their family. Well, again, that type of transaction lends itself very well to being addressed in an exit process. We want to do some heavy-duty tax planning so we can maximize after-tax proceeds from this transaction. We typically also want to do some estate planning for the business owner to make sure the estate plan is integrated with the exit plan. Also, when we do exit planning for an owner, we also need to encompass some succession planning, because part of the exit plan for that business owner is going to be to make sure that the business continues in a successful way. Typically, a business owner wants to make sure that their business legacy in the community is preserved. Well, in order to do that, you have to do some succession planning. Frequently, as part of a buyout, there's going to be some deferred component to that buyout. So the exiting business owner wants to make sure the company is going to be around in 2 or 3 years and is going to be healthy, so it can afford to make the payments to the departing owner that it has contracted to do. Now, I know a lot of you probably can't read this slide, and that's okay. It's a little bit densely packed. And I would say at this point, if anybody wants copies of this presentation, there'll be an opportunity later on to sign up, or I'd be happy to send you a copy of the presentation. But in this one slide, I give a very compacted summary of the exit planning process. And to some extent, it's the most important slide, but I just want to take a couple of minutes to go through that process. So what's number one on this process? We have to identify the business owner's objectives. As I indicated, when is the business owner going to leave? When do they want to leave? What are their financial objectives? What do they need? We have to quantify what the business owner's resources are. Well, maybe they have $2 million in a qualified plan. Maybe they own some real estate. Maybe they have a business. We have to determine what the value of that business is. So when we put all these resources together, We know what the totality is that that business owner will have after they leave the business. There's nothing worse than a business owner who wants to sell their business and it's the day before closing and they start wondering, well, am I going to have enough money to retire? Now, that's not the time we want to start asking those questions. We want to start asking those questions a couple of years before we get to that closing date. Maximize and protect business value. We want to review business operations. A large part of protecting business value involves making sure you have a good management team that's properly incentivized to maintain profitability in the business. We do a lot of planning with key employees to give them incentive compensation plans. If there's going to be a sale of the business, we want to make sure those key employees have an incentive to stay with the company after the sale, because it's going to be very important to the buyer that those key employees stay there and work for the new buyer and are properly incentivized to keep that business running strong and profitable. Transfers to third parties. Well, the threshold question there is the business saleable. We're going to talk a little bit more about that later in the presentation, but you know, the key point here is I don't care how large or profitable the business is. If that business is excessively dependent on 1, 2, or 3 key people in that company, it's probably not saleable. It could be it could be a business generating $1 million in cash flow a year. Well, and I have an example of a business like that later in the presentation. We have to work to make that business transferable, to put in place a structure in that business to render it transferable to a new owner. Ownership transfers to insiders. One of the key issues there is it typically generates a very high tax cost. And I'll talk about that a little bit later as well. Also, we want to do some leadership transition planning, making sure the key employees can run the business and continue to do so after the owner leaves. Business continuity, we want to make sure that there's a plan for the business to survive the death or disability, especially of a sole owner. And a lot of people will tell me, oh, that's real easy. Let's just buy some life insurance and disability insurance. Well, that will protect the owner's family, but it's not going to do anything to protect the value in the business. I'm very happy that the owner has a life insurance policy. If that owner's got a $2 million value business that's going to go up in smoke as a result of their death or disability, well, that's $2 million that we just threw out the window for no good reason. We want to make sure there's some continuity planning in place. And then we might want to integrate this whole exit planning process, business exit planning, with the owner's personal financial wealth and estate planning process. And the key ingredient here is time. This cannot be done in a matter of weeks or months. I normally advise business owner clients that they need 3 to 5 years ahead of the date from which they want to exit in order to adequately plan to give that owner the maximum chance of a successful exit transaction. And I can't really emphasize that element of time too strongly. It just makes all the difference in the world. Okay, so how can business owners exit their business? Well, some of you might be old enough to remember Simon and Garfunkel's song, 50 Ways to Leave Your Lover. Anybody remember that?
Yeah.
Okay. Well, I'm happy to be able to tell you that leaving your business is a lot simpler than leaving your lover. Because there's only about 5 or 6 ways to leave your business. It's not nearly as complex, but still, there are issues and alternatives that we have to consider. So, what are those opportunities? First, we could sell to an outsider, third-party sale. 2, we can sell to insiders, either key employees or co-owners. And as Marty just got through describing, one of the subcategories of a sale to key employees is a sale to an ESOP. And we'll talk a little bit about that here. I've been involved in a number of ESOP transactions, and it's always on the menu of alternatives when considering an exit plan. 4th, we can liquidate the business, sell the assets, collect the receivables, pay the payables, close the doors. Lastly, you can die with your boots on. And that happens in a number of cases where a business owner can't be pried away from that business for all sorts of primarily psychological reasons. And one day they're going to be 95 or 96 and they're going to die at their desk, and we're going to call the medics and they're going to take them out. And that's going to be the end. Obviously, that's not a desirable alternative because it leaves a lot of problems for the family and the business. Now, there's another alternative here which I didn't mention, I should have, which is a recapitalization type transaction, which we sometimes get involved in when a business owner will sell a part of their business, usually a controlling interest, 50 or 60%, frequently to a private equity group, and the business owner will retain 40% ownership, and the deal will be we have additional capital brought in by the private equity group. The owner's job is to grow the company, increase the profitability, with the idea that 5 years down the road, we're going to sell 100% of the business at a higher value. And so the owner gets what's sometimes called a second bite at the apple. An initial opportunity to take some chips off the table, and a second opportunity to sell the rest of his ownership interest at a higher price. Okay. The first critical decision, choice of successor. Whenever I get involved with a business owner, I spend at least 3 or 6 months dealing with this choice of successor. And frequently business owners come to me and they say, I know what I want to do. I want to sell my business to key employees. Or I want to sell or pass my business on to Junior, keep it in the family. I tell business owners that that's all well and good, but we need to work out all the consequences of that decision. And we need to do that ahead of time. Business owners, as a group, are a very generous bunch of men and women. Typically, they've founded a business, built a business. They want to give their key employees or family members in the business a chance to do what they've done. That is, own and run a business. However, these kind of transactions are fraught with risk, and typically the business owner doesn't appreciate the risk. Dealing with an insider transaction. We'll see a little bit later. Well, one of the key issues is, can Junior or your key employees actually run the business? Business owners tend to assume that, yeah, my son can run the business. After all, I did it, and he's a chip off the old block. Or my daughter can do it. And they're inclined to be optimistic and and generous in their appreciation of their key employees and family members in the business. It's not, doesn't always work. And we have to examine that before we get very heavily involved in the exit planning process. Is the company saleable to a third party? You know, we talked about this issue about transferability of value. Sometimes the best buyer is an insider. Sometimes that business is just not transferable to an outsider. We want to consider the tax implications. We want to consider the financing of an insider-type transaction sale. As I say, 3 to 6 months we spend looking at all of the issues implicated in a choice of successor and make sure we've chosen the right category of successor. Not necessarily a particular individual, but it's going to be a sale to a third party, or a sale to insiders, or a sale to family members, or maybe a sale to an ESOP. All those things, those alternatives should be considered. Okay, so all this is well and good, and I want to spend about 15 to 20 minutes now going through 3 live case studies. You know, it's all nice to know about this theoretical framework, about how does this exit planning process work. So I want to take you through these examples so you can get a feel of how this type of stuff works in practice. Case study number 1, a sale of a manufacturing company to key employees. Okay, so this is a company located in Lancaster, Pennsylvania. Do about $35 million in sales. Their major product line is the sale of security windows and doors to U.S. embassies and American corporations around the world. So, for example, they're going to be installing the windows and doors at the American embassy in Kabul, Afghanistan, or Baghdad, Iraq, or Moscow, Russia, or Cairo, Egypt. And it's not only explosive-resistant doors and windows, but tamper-resistant doors and particularly windows as well. The windows they install can't be penetrated, or it's very difficult to penetrate by electronic devices, okay?
So they didn't have those at Benghazi, I
I think Benghazi was a client of this customer, but, you know, that's a good question. I ought to go back and check. But Benghazi was obviously a special case. Their profit is somewhat erratic because they're government contractors. So a large part of their business is government contracting. So cash flow is going to vary significantly. The owner is 74 years old. He's an engineer by training. He bought this company 35 years ago when it was maybe a $800,000 a year business, built it up to its current value. Got 140 employees. We hired an outside appraisal firm to value the company. They valued it at $7 million. There was a complication which we don't really need to go into, which this company had a separate line of business which was spun off in a IRC 355 transaction as part of the exit plan, but doesn't really enter directly into our consideration here. So what was the process that developed here? First of all, I was referred in by the company's attorney. The attorney understood we have a 74-year-old business owner who actually wasn't in the best of health. We needed to have an exit plan for this guy. What was going to happen to the company? The owner's goal was to have enough cash after this transaction to support him and his wife during retirement. And he was also very concerned of benefiting employees. One of the first things we mentioned to him was an ESOP, and He didn't like that. He wanted the employees to directly own stock in the company, not as part of a qualified retirement plan. The attorney and I had spent some considerable time convincing him that that really was not a practical alternative. I got involved. It was a five-man, it was actually 4 men and 1 woman management team. The owner wanted to transfer significant ownership to this 5-person team. Now, as a general rule, transferring ownership from one person to more than one person is difficult. And in this particular case, as I say, I spent a lot of time with this management team. I probably spent 6 to 8 hours with each of the 5 members of the management team over a period of a month. And we went through a whole series of discussions, company analyses, strategic analysis. Well, the conclusion really of this process was 2 of these key employees, they really didn't want to have anything to do with ownership. You know, they were smart enough to know that they weren't really cut out to be business owners. You know, they didn't want to take on the responsibility and risk. And that, as we'll see, that's something that business owners don't ordinarily appreciate. The president of the company, who was one of these 5 key employees, well, he decided, apart from these 2 who didn't want to be owners, he didn't want to be partners with one of the other 2. And he said, you know, I just don't feel that on a long-term basis I can work with this person. Okay? That was also a bit of a revelation to the owner of the business. The 5th person was about 62 years old. They were he was perfectly willing to be an owner, but he only had about a 3 to 5 year time horizon with the company. It didn't really make sense for that person to go through the financial sacrifice of acquiring ownership in the company and only being an owner for 3 to 5 years. It would have taken him 3 to 5 years to buy into the company, at which point he was gone. What's the point? So the end result, as we decided, really, there's only one person in that 5-person management team that's a good potential successor for the owner of that company.
Qualified?
Excuse me?
Was he qualified?
Yeah, he was terrific. He was about 45 years old, an engineer by training. He had worked at the company for 15 years. He was the operating president of the company. He was the guy who really made the company go. He was a great candidate. So the result of this was to whittle it down to the one good successor here. The CPA firm did an analysis of the owner's financial situation and determined that he needed a minimum of $3 million after tax, after resulting from this transaction, in order to support himself and his wife. One little complication for this owner who always used to tell me how modest his personal financial needs were and what a modest lifestyle he had. This is all true. The only fly in the ointment was that he owned a $3 million boat and had a $2 million loan on the boat, and his monthly boat payments were about $25,000. So, apart from that minor detail, he's a 74-year-old guy, you know, apart from that minor detail, you know, his financial situation was relatively simple. So the lawyer and I recommended that the owner consider an ESOP. And we brought in somebody like Marty, who is part of an ESOP consulting firm in the Philadelphia area, to do an ESOP assessment on this company. And this is just coincidence that I didn't know Marty was going to be speaking here, and he didn't know I was going to be talking about an ESOP case. So, what were the results here? Okay. What was the plan we came up with? First of all, over a 3-year period, we were going to pay the president a stock bonus so that he could acquire 10% ownership in the business. Now, Marty, he poo-pooed stock bonuses. He said, you know, the employee's getting a piece of paper and I got to pay tax on this? Remember that? Well, that's all true. What Marty didn't tell you, though, is the company gets a tax deduction on that piece of paper. So they get a deduction for a non-cash transaction. So typically what I do in employee stock bonuses, which I love, Hachi, Marty, we have to gross up the bonus in order to pay the tax. The company still gets a deduction for that compensation. But so this owner needed $700,000 a stock bonus of a net of $700,000 to acquire a 10% ownership interest in the company. We had to gross that up to about $1 million. So yeah, the employee paid $1 million, got $1 million in compensation, had to pay $300 or $350 in tax. Pennsylvania tax rates, by the way, are a lot lower than California. And the company got a full deduction for the $1 million. Now, the owner of the company, my client, was in a lot higher tax bracket than the employee who was getting the stock bonus. So if you do a total net tax assessment here, Uncle Sam was out about $100,000 on the transaction. So in my book, that's why stock bonuses are smart tax plans. Not all the time, but in many cases. We also got the president to take a personal loan for $700,000 to buy another 10% of the stock. Now, the company had to partly guarantee some of that loan because the bank wasn't going to lend this guy $700,000 on his signature. We didn't want him to have to put his house up as collateral. And the company had a relationship with the bank, so we were able to work out a deal. And frankly, it's important to me, generally, that people don't put their houses up as collateral. That's not something I encourage. The attorney did an estate plan, and among other things, we had to make a provision for what was going to happen if this guy keeled over and died the next day. Because he didn't have any children. The attorney set up a trust to hold his stock pending the completion of this exit plan. We did an ESOP transaction, phase 1 of the ESOP transaction, 35% of the value of the company was sold to an ESOP. Now, Marty made reference to this, but something you should take note of. When you sell a minority interest in a company to an ESOP, there's a significant valuation haircut. That is, a minority interest is worth at least 25% less than the pro rata value of the company. In my experience, the more typical haircut is 30 to 35%. So on a minority sale to an ESOP, you're going to get about 30% less than the fair market value of the stock. And that's okay in some circumstances, but that offsets some of the tax savings you get on a 1042 transaction when you're looking at tax-free proceeds. Now, in this case, that was an acceptable cost to the owner because we were still able to get him his $3 million after-tax number, even with taking, it was about a 33% haircut on the value of the stock. So we did a phase 1 ESOP sale, and the plan is after that loan is paid off, we're going to do a phase 2, sell another 35%. The end result's going to be the ESOP's going to own 70%. The president is going to own 20%, and our original owner is going to retain 10% interest in the company. Okay, case number 2. This is a one-employee company, a sole owner, sole employee consulting firm. Now, there was really another employee, which was the owner's wife, who was paid $15,000 a year for bookkeeping and such. That didn't really count it. But this was one of the most challenging cases that I've been involved with, and really potentially one of the most gratifying. Because what are the facts? Joe is the sole owner and, as I said, sole employee of a consulting firm that does $2 to $3 million a year in revenue. And his consulting includes really sales consulting work for luxury automakers. Some of his customers are Porsche, BMW, Land Rover, Audi, companies like that. And Joe is able to, one of the key skills that Joe has is what he calls major account selling. It's not easy to sell $1 million contract to BMW. You have to develop relationships in the company. You have to convince the company that you can actually perform on the contract. It's a multi-year selling process. So that's a particular skill Joe had. Joe also did some project management work. Now, I just want to show you here, the 2015 estimated financials, about $2,750 in revenue, $1.1 million in gross profits. The $1,650,000 was all paid to independent contractors. Joe has a network of independent contractors that actually provide the services for this company. And he's kept this network of independent contractors together for 10, 15 years. He drops some, adds some as he needs to. And that's how he makes his company work. The question here is there any transferable value in this business? The $64 question. Who's going to buy Joe's company if Joe's the key guy in the business? Does this business, which is making $600,000 a year, have any value apart from Joe?
If it has residual income.
Okay, but residual income, that ain't worth a whole lot. I'm talking about value as a multiple of profits. And we came up with some exit options for Joe. One was to develop an internal successor and sell the business to that internal successor. Another was a sale to a third party, and I think the sale to a third party is feasible because what Joe has, in effect, is a customer list. And that customer list is in large part transferable because Joe would enter into master sales agreements with BMW and Porsche to provide services over a period of time for $500,000 or $1 million. And Joe could probably transfer those customer relationships to another buyer. Another option for Joe was he could simply say, I've been doing this for 20 years. Yeah, I've been very successful, but I don't care what business you're in. Making $600,000 a year causes a certain amount of stress in your life. Okay? And Joe was at a point in his life when he said, you know what? This is getting a little bit too stressful for me. So maybe I ought to just throttle back, downsize the business to a level that I could handle comfortably. And I could do that for another 5 or 6 years and then just wind the business down and liquidate. Now, what Joe decided to do was bring in an internal successor, try to train that person to the point where that person can run the company and might be a buyer for that business. And going to be a very complex process that we just started on. My view is that the ultimate result here is going to be, Joe's going to bring this, has brought this person in. We're probably going to sell this, if this person is successful, we might sell 10 or 20% of the business to this person. And I think at that point, Joe will be in a much stronger position to sell the business to a third-party sales consulting firm. Because then it won't just be Joe. Joe will have an internal person who knows the business, who's 15 years younger than Joe, who can help with the transition and move that business forward under new ownership. The trick is going to be to provide appropriate incentives to that internal successor key employee so that they will be properly motivated to work with a new owner to make that company go. And if we're successful in that, I believe my company will have brought Joe a transferable value number in the range of $2 million for a business that has $2.5 or $3 million in revenue. So this is a small company, but it's a small company in which I can provide very high value services. I can help Joe create a value in the order of $2 million. If it's not $2 million, it's $1.5 million. Where previously, Joe really didn't have any transferable value to that company.
Why wouldn't you sell to somebody that already has those businesses, that are already entrenched in that?
Well, that's a possibility, but Joe was concerned that somebody wasn't going to buy the business if it was just him. Now, I didn't agree with Joe. I think you're right. If it had been my call, I would have said, let's go ahead and try to sell this business over a period of years, creating some program in place for Joe. Joe really didn't want to do that. He thought it would continue to be a very high stress relationship and job for him, and he didn't want to do that. Okay, case study number 3. Okay, this is a family business. Now, I wanted to mention here, this is my exit planning library. I have 3 books here on various facets of exit planning. These are my personal guidebooks. There's a lot of books out there on exit planning. One here is written by really my mentor, a guy named John Brown, called How to Run Your Business So You Can Leave It in Style. Another one written by a guy named Kevin Short, called Cash Out, Move On, How to Sell Your Business. And this third one is about family businesses, called Every Family's Business by a guy named Tom Deans. And if anybody has interest in these books, I'd be happy to talk to you about it afterwards. But family businesses are their own animal. I mean, they are a case apart. So what do we have a situation here? Dad, we'll call him Marty, was 62 years old. He founded a company in 1992, which is what I call a super premium kitchen cabinet manufacturer. What do I mean by super premium? Well, to buy a set of kitchen cabinets from Marty's company, the wholesale cost starts at about $50,000 and can hit $200,000 very quickly. The retail cost is typically twice that. Marty's customers are not you and I, people who walk into the store and say, I want to remodel my kitchen. Marty's customers are high-end kitchen designers and architects. And Marty does projects all over the country. He's done some in San Diego, Santa Fe, Park Avenue in Manhattan, Fifth Avenue in Manhattan. He recently did Bloomberg's Hampton home, helped him install a new kitchen. So these are major projects, strictly custom. I mean, there's no you know, there's no inventory in this business. The only inventory Marty has are exotic hardwoods. And I mean exotic, like stuff that you get in the rainforest in South America or get in certain parts of certain forests in Germany. He stockpiles these exotic materials because when you get to this level, nobody wants to have the same wood that, you know, somebody else in their, you know, super luxury Fifth Avenue apartment condo co-op building also has, okay? You know, it's like designer dresses for women. You know, you don't want to go to the opening of the Met, the gala event, and be wearing the same dress that somebody else is. Everything is absolutely unique. Okay, so annual revenues 12 to 15 million, profit about $1.5 million a year. This, again, we had an independent appraisal company valued the business at $6.5 million. There are 3 children in the family. The oldest, Charlie, was by training an engineer, went to engineering school and spent about 12 years working for Fortune 500 type companies as an engineer. The second child, Kathy, is a PhD psychologist who has started her own psychology practice. And the youngest, we'll call him Louis, he was a little bit of the black sheep in the family. He had bought a small company. Louis was interested in airplanes, and he had bought a little refinishing company for airplanes. Ken tells me I have 5 minutes left. That's great. We'll try to wrap it up. So my initial meeting with Mom and Dad. Dad comes into my conference room with a whiteboard, and Marty tells me, this is my plan. I want a family holding company. This family holding company is going to own all of the businesses in the family. It's going to own the cabinet manufacturing company, it's going to own Kathy's psychology practice, and it's going to own Louis' small airplane refinishing business. And we're going to have a board of directors where the kids and the family are going to be on the board. They're going to be in charge of making the critical decisions for all these companies. Well, that sounded to me like a recipe for disaster. So I asked Mom, well, what do you think of this? What do you think is a good plan? Mom tells me, all I want is for my kids to be happy. So I have control freak Dad here who is going to run every last inch of each of his kids' lives. And I have Mom here saying, I just want my kids to be happy. I didn't ask Mom, but I said, Mom, do you think your kids are going to be happy with Dad's control freak structure here? Well, it seemed to me the answer was no. So we had to work through this situation, other family problems. Dad and his oldest son, who came back into the business to be the heir apparent, well, the only problem was they never talked to each other. I mean, the kids supported the idea that Charlie should run the business because he was the only one in the family that could run the business, and they knew it was important to Dad that keep the business in the family. But Dad and Charlie never spoke at all. So we had to bring in, get involved some really psychologist types to, sorry, I didn't catch that? Therapists, right. I have, not a partner, but a guy I work with very closely who's a PhD psychologist. And I always call him into situations like this. This is for real. He's a business psychologist. That's what he does. I know when we get above my pay grade. We developed a plan which included transferring the business. We used a grantor retained annuity trust and a charitable lien annuity trust. Those terms mean anything to you folks? So we did a zeroed out grant where we were able to transfer about $5 million of business and real estate value to the next generation tax-free. This family had significant charitable interests. We used a charitable lead trust in which we put about $2 million of assets that was generating $300,000 to $400,000 of income every year. All of which went to charity. The remainder went to the kids. So all told, about $5 million went to the next generation tax-free. And that was the result of our plan. This is, again, an ongoing project because we've got to keep Dad and Charlie talking on a regular basis on business issues and family issues. Key takeaways, relationship issues, a whole nother subject I won't go into, equalizing your estate among the children. Here we have one child in the business, two children not in the business. Well, what does that mean to the family if the oldest son gets the business, quote unquote, and the other kids don't? Does that mean that the oldest son is getting a disproportionate value? We have to do some counseling on the financial issues involved. And we took advantage of these highly leveraged estate planning transactions to get substantial value to the next generation. This is probably going to be the last topic I have time for, executing third-party sales. One of the key values I bring to my clients is helping them sell businesses. I am not a business broker. I don't actually market to sell businesses. I don't get commissions on the sale of businesses. But the key thing I do is work as a matchmaker between my client who wants to sell a business and transaction intermediaries. You know, every successful business owner is flooded with mailings, faxes from brokers and other transaction intermediaries saying, hey, you know what? I got somebody sitting in my office right now who's willing to write you a check to pay you top dollar for your business. Have you ever heard about this with your business owner clients? Well, I'm sorry to be the one to have to break the news to you, but that in every case is not true. Business owners need to know who is the right person to sell your business. I have a number of articles here. I have a monthly column in a local, in a Central PA Business Journal. And one of the columns I have here that you can take a look at is how to sell a business. Who should sell your company? And who should sell your business? Sorting out the potential middlemen. In order to know who should sell the business, you have to know who the likely buyer of the business is. Is the buyer going to be a private equity buyer? That is a financial, no, don't pass them out, just leave them there. Is it going to be a financial buyer, like a private equity buyer? Is it going to be a strategic buyer, like a larger company in the industry that's looking to make a synergistic type combination in the deal? Because different types of transaction intermediaries are going to specialize in different types of transactions. So, for example, I have two investment bankers that I work with exclusively in transactions greater than $20 million. And one of them is located in Chicago, one of them is located in St. Louis. The toughest thing to find in this arena are intermediaries who can sell businesses in the range of about $3 to $15 million. It's very hard, especially in strategic sales. So I found two good companies who specialize in that arena. One's in Philadelphia, one's in Denver. And that's what they do, and they're good at it. And hooking up your client with the right transaction intermediary can be of tremendous value, a tremendously valuable service that you're providing to your clients. So we're not going to get into the financing issues. As I say, if anybody wants a copy of this presentation, I'd be happy to give it to you. Just let me know. There's going to be some sheets coming around where you can sign up for those things. I would make one comment. The one problem I have with CPAs, especially on insider transactions, is that they're telling their clients to use installment sales for sales to key employees. That can be disastrous from a tax perspective. It's what I call an around-the-horn double pay for you baseball fans. Because the cash flow to pay off that installment note is generated by the business. It goes to the buyer who pays tax on that money, and that money then goes to the seller who pays capital gains tax again. The total tax on that business cash flow and that transaction frequently exceeds 45%. And there are a lot better ways to do that. So please, I ask you, if you're going to advise your clients on how to structure a sale to a key employee, there are lots of other things you can consider besides installment sales. I've listed a few of them here. We talked a little bit about continuity planning for sole-owned businesses, how to make sure that that business is going to continue. If the owner dies or becomes disabled, some of the key ingredients for a successful exit, a written exit plan. I don't work with any business owners unless they're willing to commit to putting an exit plan in writing. Otherwise, nobody takes it seriously. You need an experienced team of advisors, cash flow, quantifiable business value, a management team in place, and time. Characteristics of your exit planning team: the owner selects these people, various specialties as appropriate. I indicated as we went through some of these cases, some of the specialists I brought in, from attorneys to ESOP specialists to valuation professionals. Qualified plan specialists can be very, very important. With that, I'll conclude. Again, it took about 60 minutes. Thanks very much. It's been a great conference so far. As I say again, I hope you've enjoyed it as much as I have and have gotten as much out of it. Thanks very much. Anybody with questions, I'd be willing to certainly be willing to talk to you.